Hello and welcome to Expert Bytes on moneypuzzle.in. If you're a do-it-yourself investor, a keen stock picker, then our guests today are perfect for you. They are not only great stock pickers and fund managers, but also very articulate about how they do it. Get ready for an engaging and exciting conversation with Saurabh Mukherjee, Rakshit Ranjan, and Salil Desai around their latest book, Diamonds in the Dust. Hi Saurabh. Rakshit, Salil, hi. And thank you so much for being here on moneypuzzle.in.
Pleasure.
Okay, so, before we begin, I'll just say that I loved reading your book, and it almost seems like it should be the text for, some MBA college on stock selection and stock markets or something. But I was also amazed by the level of detail in it. And we will get into all of those things, in this discussion here.
Thanks, Priya. There's a reason all of us are wearing specs here, right? You can see years misspent reading annual reports. But thank you very much. Appreciate the fact that you love the book.
All right, so let's just begin at the start, and just to pick your brains on what you were thinking while writing this. And I had read your earlier one as well, Coffee Can Investing. And I think this one really kind of picks up on where that left off, which was really about, telling investors to be mindful about stock selection. But here you're really getting into the details of how to do it. So what is the thought process behind that?
Yeah, so I'll take that. So Lisa, in Coffee Can Investing, actually, we compare equities as an asset class with gold, real estate, and various other asset classes, and concluded that actually equities make the most sense for an investor from a long-term perspective. In Diamonds in the Dust, we are providing a framework to the reader to help him or her execute stock selection and building an equity portfolio themselves. We're talking about three broad aspects of building an equity portfolio. First and foremost, the accounting quality piece, right, which we believe is actually the biggest risk that an equity investor faces in India. We've provided a checklist giving examples on how accounting fraud is carried out in India and how you should make sure you stay away from it. Second is we've provided a checklist and frameworks on how to assess capital allocation discipline of a company. And as a result, how can you not pick up companies which might have a great core business, but they might not sustain the greatness because the capital allocation is not in the right direction. And the third aspect that we've talked about is this whole excitement around trying to time the market. Where in the book we've given a lot of data to help convince the reader that even if they are very successful by a matter of luck, right, or as we call it, hand of God on your head, in trying to time the market, provided you're investing in high quality stocks, you won't get too many benefits of that, right? And in a sense, timing the market is not only difficult, it's also not rewarding enough, even if you had luck on your side. As long as you're invested in high quality stocks, just staying invested at all times, it helps you compound in a disciplined way. So that's the sort of combination of checklists and frameworks with case studies that we've provided in the book to help the reader build their equity portfolio.
Right. And I'm guessing this is what you all do anyway on a daily basis, right? When you're looking at companies and trying to figure out your stock selection, etc. And at any point when you were writing this, did you ever think that, oh my God, are we sharing too much of what is really making our stock selection process unique? Because you all run a PMS as well, you have clients. So did that thought ever occur that it's too much?
I think, Lisa, whilst one can get fearful of all sorts of things in India, I remember 7 or 8 years ago, the fuse in the office had blown, right? And we have several electrical engineers from various prestigious universities in our office.
Yeah.
So I asked them, can you repair the fuse? After all, I'm not an electrical engineer. I just studied economics. So all of these, prestigious alumni from the best electrical engineering courses in the country said none of them knew how to repair a fuse. So that's when I realized that you can have as much theoretical knowledge as you want. Translating it in the practical world is a different thing. Similarly with us, right? Is that we must have read 40 books on Warren Buffett's style of investing, but it took a solid 10 years of research, thinking, effort before we figured out how to invest successfully. And therefore, whilst we would love people to read our book, if anybody believes by reading our book they'll discover our secrets, unfortunately, it's not so easy. A lot of what we do is psychological. What we do is simple, but it's not easy for others to replicate, because a big part of it is mental discipline. Right. So to be able to buy stocks consistently, including through periods like March, April 2020, when the world is panicking, is years of mental training. What we've tried to put in the book is the techniques that we bring to bear. What we haven't been able to put in the book, and probably won't be able to put in any book until perhaps Mark Zuckerberg creates metaverse, is the psychological discipline, the psychological effort required to practice the same thing again and again, to put to work diamonds in the dust, into our $1.5 billion of assets under our care. To put the book into use every day is almost a physical effort, and that's what separates us from others. And therefore, we are very confident that our book will help others understand what we do, perhaps begin the process of mastering the techniques. But I doubt we have given the essence of our secrets away. I wish it was as easy as that.
Yeah, I'm sure. I mean, you talk about psychological discipline, which is an overlay on this process that you've kind of spelled out in the book. Would you say that there is an element of intuition as well?
Where intuition comes in is knowing when to apply which tool in the book. So, for example, as you would have seen in Diamonds in the Dust, the opening parts, the forensic accounting chapters, then you come to the chapters on moats and comparative advantage, and then you come to the chapter on capital allocation, presented with, say, a specific announcement. Say one of our investee companies acquires another company. Which of these three toolkits are the most relevant at that juncture is probably where the years of practice and intuition come in.
Right. Interesting. And you have given a lot of tools to the readers. One of them where the book really talks about moats being, a contributor to the whole stock selection decision. Can you just maybe talk about 2 or 3 ways to identify the presence or the absence of impactful moats when you're sort of starting to look at a company?
I'll take that. So Lisa, what a moat essentially allows you to do is build a barrier around your business where competition cannot come and hurt you, right? So whether it could be in terms of your pricing, whether it in terms of your costs, your working efficiency, no matter, everything that allows you to make a certain return on capital. Right. A moat will make sure that competition does not do something which dilutes that return on capital. Now, there are many different ways in which you can assess a moat, right? One of the frameworks that we have detailed out in the book is what we call as the IBSA framework. You have 4 distinct sources which will allow you to build a moat, which is innovation, brand, architecture, and strategic assets. I won't get into details of these. It might be easier to read it, but I'll give you a couple of examples to know how to identify moat. Right? What you essentially need to do, or what an investor essentially needs to do, is to figure out that why is a certain company or certain business able to earn a return which is higher than the nearest competitor, right? And once you identify that, you figure out that is that advantage durable, sustainable, right? And how long can that sustain? Right. So, for example, again, a case study we have used in the book is of TCS. Right? TCS is the largest software services company in India, the second largest in the world, and they've been around for 50 plus years. If you ask anybody in the amongst the competitors, they will tell you that TCS is the most aggressive when it comes to pricing.
Right.
Yet TCS has the highest margins amongst all Indian companies. Right? So if you have the lowest prices and the highest margins, there is something which you're doing which nobody else is able to do. So that is the moat that TCS has. Right now, you go and dig deeper into where this advantage comes from. Right, what we have found out is that one of the sources amongst the many is that TCS has been able to hire, train, and deploy people at scale, which nobody else has managed. You combine these with employee or say HR initiatives, which helps them to have the lowest attrition rates amongst peers, which means that your need to retrain people, fewer people are leaving. So that means you have to hire fewer new people, which means you have to train fewer new people, right, which gives you a distinct cost advantage, and that becomes a virtuous cycle. Compare this with some companies where attrition rates are as high as 30%, which means that 1/3 of your workforce is leaving every year. Right? You have to replace them to make sure that even your regular business is continuing. Forget about growth. So one way to assess this, using the IBSA framework, is to figure out that which of those attributes does a company have, which nobody else has. Right. Another example we have spoken about a number of times is Asian Paints. Asian Paints delivers directly to paint dealers. Right. There are no middlemen. Now, to deliver such a voluminous, bulky product directly at the point of sale, and knowing that what is going to sell, right? Because the dealer obviously is not going to store every possible color or shade combination that is there. You have to know what's going to sell, right? So you take a step back and figure out, okay, for this I need to forecast demand. To forecast demand, I need something else, and so on and so forth. Right? Now, this has been built by Asian Paints using a combination of technology over many years. So the ability for Asian Paints to forecast demand, use that to sell directly to dealers, and make sure that nobody else can achieve that is something which is a durable competitive moat. You have to, like I said, to summarize, you have to figure out what is one thing that you're doing which nobody else is being able to do. Then try and understand that how it has been built and whether there is any chink in that armor.
So I think the Asian Paints case study was my favorite in the book to read. But this is very interesting. So you put it in this one sentence: how is the company able to do what it does better than its competition? And you ask that question, and then you start to dig deeper into what the answer could be, and that's where you'll probably be led to these moats, and trying to figure out how sustainable they are, etc.
Exactly. In fact, just to kind of add here is that what you say, you need to dig deeper. Sometimes, on the face of it, seems like this is a great brand, right? That brand is a moat. But again, we have a section in the book which is a brand is not necessarily a moat unless a brand allows you pricing power, right? If competitor is giving a huge discount, but you can hold on to your market share by not cutting prices, right? Yeah. That is a moat, which is not coming from your brand, right? So I leave this as food for thought. You can read the book, and readers can read the book and figure more out about it.
Excellent. So that was one of the things. And another aspect that you spoke about was capital allocation and how important those decisions are in the future, and also in maintaining that, the trend, the earnings trend and the profitability trend. So if you can, highlight maybe some of the thumb rules that you mentioned in the book to analyze the potential success of a capital allocation decision, because how it works out, you find out only later, right? Just to give a sense of how can one view this when it's happening, really, how to assess that.
So that's a very important aspect to understand about a company. What Salil just talked about and what you just highlighted as pricing power or moat or competitive advantage, right? That generates a lot of cash from the business, right? Where capital allocation becomes important is that if you don't reinvest that cash in productive manner, then the business doesn't grow, right? So to deliver growth, not just cash at the existing scale, in order to scale it up further, you need capital allocation decisions to be in areas where incremental capital gets deployed with higher return on capital employed, right? So your existing core might be delivering 30, 40, 50% return on capital, but if you don't deploy the incremental investments in areas with 30, 40, 50% returns, then overall returns will fade out eventually, right? So that's the importance of capital allocation. How do you assess it? So there are 2 or 3 areas in which you have to sort of segregate the assessment. First point is you have to figure out if capital allocation is helping the business strengthen its moats further, right? Presence of moats is one, which Salil talked about.
Yeah.
You also need to strengthen the moats because otherwise competition will catch up with you, right? The second area where you need to assess capital allocation is around adding new revenue growth drivers, because any business, if it sticks to just one type of a product or one type of a geography, right, at some point in future, either competition will catch up or there'll be sort of saturation of growth potential, right? So being able to actually leverage on existing core strengths and add new revenue growth drivers, which also have high degree of moats and pricing power, is the second area of capital allocation that you need to assess. And then the third bit is you need to keep radically disrupting yourself, right? Otherwise, once every 10 or 20 years, there is a possibility that some technology disruption or some aggressive competitor will come in and try to take customer base away from you. You need to keep changing the reason why market share will be defined in your industry. If you do that, then you keep competition at bay on a long-term basis. And then in the book, we've also highlighted that it's not just the tangible monetary capital allocation, it's also the human capital,
right?
The succession planning aspect, the institution building aspect, right? The empowerment and decentralization of control. All of that is also in a way part of capital allocation.
Yeah. So, so just to summarize, so you're talking about how the capital allocation can be linked to strengthening of moats, which already exist in the business. How can it contribute to the incremental revenue, the new revenue? The last one was about resource allocation, not just the monetary, like the capital allocation, but also human resource. Can you just explain this one a little bit more, the radical disruption? Is there an example that you can give on how a business can, radically disrupt itself?
Yeah, so there's one very interesting example. If you really see the paint industry, which you were just mentioning, Asian Paints, and Salil highlighted about the supply chain moat of Asian Paints. What Asian Paints and many great companies in India have done is they have avoided price increases beyond a point. Why? Because they try to derive operating efficiencies better than their competitors, and hence by avoiding price hikes, they are on the one hand making their products more affordable. On the other hand, they are making it difficult for competition to sustain or survive, because the competition can't increase prices if the market leader isn't increasing prices, right? Now, that's one element. What that has done is, over the last couple of decades, when we as homeowners get our houses painted, labor cost as a percentage of the paint project has gone up multifold. Why? Because the labor cost has gone up at CPI, but paint material prices have gone up at only 2 or 3% CAGR, because Asian Paints hasn't hiked product prices, right? So you pay for two things, labor and material. Material hasn't gone up as much. Labor has gone up significantly more. Today, 70 to 80% of a paint project is labor, right? Now, that opens up an opportunity for disruption. Somebody else can come in and say, well, Asian Paints, you've built a moat competitive advantage around paint material supply chain, but customer is actually paying for labor. So let me actually disrupt your dominance by offering something around labor. Now, interestingly, Asian Paints is the company that identified that about 13, 14 years ago. And over the last decade and a half, they've worked on trying to figure out a sustainable way to add value to the customer using labor-oriented services. Right now, they are in a way changing the reason for customer choosing Asian Paints rather than something else. So far, the reason was that the paint dealer won't stock anything else, and hence the contractor will push this. In future, it will be the customer will say that, look, if I go for Asian Paints, the labor services are much more value added, and hence I want to choose Asian Paints. If you keep re-engineering like this, then an Amazon or a blockchain technology or some other Patanjali equivalent can't come in and disrupt you easily.
Yeah. Very interesting. Not increasing prices leading to labor. Very interesting. Excellent. So let's get into some other kind of disruption now, which is really, something that your book also alluded to in various case studies, and something we see in our capital markets all the time, which is the role of credit rating agencies. And it's an important thing because, it's visible, and a lot of individual investors do get into seeing, how the company is rated, and it affects the debt issuance, but also, the equity perspective as well. So what are your thoughts on this subject? Because we've seen the failure happen, and, that causes a lot of ripple effect as well. So what are your thoughts on this subject, and how can one sort of manage it while getting into stock selection?
So Lisa, if you look at the history of stock markets the world over, the history is basically half of the history of stock market is really the failure of various intermediaries who are supposed to be providing services for investors, but instead turn out to be captured by the promoter community. So whether it's the whole Arthur Andersen blow up around Enron, the accounting scandals in the late 90s in the US, or Satyam in India, ILFS, and the first half of Diamonds in the Dust focuses on four accounting fiascos in our country, companies where the promoters stole billions of dollars with really no intimation to the public by the auditors who stood there and watched the promoter empty the coffers out, right? So the audit community obviously has a lot to answer for the world over. This is a challenge the world over. In our country, in public, right at the moment, in public, a punch-up is playing out between the ICAI and the NFRA on this whole subject. Similarly, credit rating agencies and their inability to actually sound the alert when it's useful, and then at the last possible moment they downgrade it to default, and it serves no purpose. So the history of investing the world over is a history of brokers, credit rating agencies, auditors letting the investor down. And one of the lessons I think we should all take away from this is you got to do your own homework if you're putting your money to work, right? You cannot rely on outsourced opinions, whether it's opinions from a broker, it's opinions from a credit rating agency, or the auditor's opinion. You have to do your own homework. It's very similar to what I would say what we do for security. All of us have the greatest respect for police force in our country, but every building that I know in Bombay has its own security, because every building realizes that either we look after ourselves, or really it's open season on our cars, on our property, on our families. Very similar with investing. It's so interesting, Lisa, when it comes to physical security, we're able to clock the concept immediately, and every building happily pays money to have 10 security guards protect the premises. When it comes to financial security, bizarrely, we let our guard down and say, whatever this fellow in front is saying, I'm going to trust him. It doesn't work. And I don't think in the remainder of your and our careers, there will be an easy solution to this. The auditor, the credit rating agency naturally will listen to the promoter rather than the investor. And therefore, it behooves all of us to learn the basic techniques of financial analysis so that we can protect our own money rather than depending on the kindness of strangers.
Yeah. So excellent. So what you're really saying is that if you want to be a stock market investor and pick your own stocks, then it's important to do your own homework as well.
That's right. Nicely put. Either you hire a fund manager, or you say you're going to do your own work. But in that case, don't say I invested because that broker or that credit rating agency or that auditor signed off.
Yeah, I mean, I did mention auditors in my question, but you're right. I mean, it's really, both these aspects which kind of are there to actually give investors the reassurance. But I think over time,
it's the same conflict of interest. It's the same conflict of interest.
Yeah, exactly. So over time, we've seen that it has not really worked. And when things go wrong, they go wrong massively, and with a lot of capital loss at the other end for investors. Okay. Okay, so let's talk a little bit, the idea, of course, now we see a lot of young investors getting into all kinds, the options and the choices are also a lot more in terms of where you want to invest and what assets you want to pick. a lot of your philosophy really leans on, the long term, finding value over decades even. But a lot of investors today really are looking at that quick buck, and that's what we're seeing happening across the newer asset classes that have come up. How does one reconcile that? And in the stock market particularly, are there any examples where short-sightedness and trying to make a quick buck has landed in really a deep ditch and people have lost money? If you can highlight some of that, maybe it can help our listeners as well.
Right. So Lisa, I guess the last, say, 18 odd months, the way the markets in general have been, or say some other options like you mentioned have come through. It seems that whatever you do, you'll make money, right? Yeah. Now that's a very you can say that we can call it a recency bias, because it has happened once. Everybody thinks it keep on happening for all the foreseeable future. But obviously, that is not really the case. You can go back and study market history, economics history, and you will find that never really happens. Right. So what you need to do is that if you can't find a repeatable idea, maybe I invest in something today and it gives me a great return. Do I have the ability to keep finding these get rich quick schemes or stocks time after time and again, right? At least we don't think that is practically possible. So the first thing you need to do is get out of the temptation of buying the next hot thing, or the flavor of the season, or the momentum stock, or whatever the market parlance calls it. And that is why we are also obsessed with the word consistent, right? You'll find that word right from the cover of the book all the way till the last page, right? Multiple times you be consistent. The reason is that once you pick a stock, right, or a portfolio of stocks, the businesses will grow consistently. Your wealth will also grow consistently, right? And then the power of compounding kind of starts kicking in, right? So if you're generating, let's say, 20 or 25% return year after year after year, right? Then in 10 years you can actually make tons of money. And I think we think in India the opportunity is right to really start making tons of money over the next 10, 20, 50 years. To put this into, say, some context of some numbers, right? We have shown with numbers, very simple. Forget stocks. Even if you just invest in the market, right? The longer you invest, the greater are your returns. So, for example, if I quote a 20-year investment purely in the index would have given about a 15% odd return. The same return over a 10-year period would be about 13 and a half. Right? With stocks, it becomes all the more prominent in the sense that the returns kind of keep growing, right? Because businesses need time to build competitive advantages, right? Reinvest, sustain those, and as businesses grow and they keep on increasing the gap between themselves and the competition, right? The ability for those businesses to make money keeps on growing at a much faster pace. You have to be with those businesses, right? Rather than thinking what's going to work today or tomorrow or for the next 6 months, you should think what is going to work for the next 15, 20, 25 years. Right? So your financial goals in life are kind of in sync with where they are. So we would urge people not to really chase what your neighbor is buying today, or what you're hearing in the newspapers, but try and focus on consistent returns. That is the only way where you will make tons of money over the long period.
Yeah, so it's interesting you say this, because when you look at a business, so if you're a business owner, you wouldn't want volatility in your earnings, right? Exactly. You would want consistent. But when you become a shareholder, you still own the business, but there there are 100 strategies to take advantage of volatility, for example. Even though, as your book demonstrates as well, consistency is really great.
Lisa, I think you captured the difference nicely. The challenge is if you invest in stocks, there's something called the stock price you can watch every day. That breeds envy, right? Uski kameez mere kameez se safed hai. In your own business, there is no stock price flashing in front of you. So one of the best ways to avoid envy, one of the best ways to follow Salil's nostrums is to avoid looking at the portfolio, at the stock price. If you really want to blow your brains out, then that's when you look at the stock price every day. The less you look at the stock price, the more money you'll make.
All the best to everyone out there with that, because that's impossible in this age of instant technology and social media. Even if you're not looking at your stock portfolio.
That's why I'm on no social media platform barring LinkedIn.
Yeah. Good. I mean, that requires the discipline you were talking about earlier, Saurabh. Okay, so moving on. So also what happens is sometimes bad things happen in good companies as well. So, you've picked your quality picks, you're willing to hold on for the long term, you're willing to do all the homework. And then, the company sort of misses the earnings trend and it's moving in one direction, but has, 1 quarter or 2 quarters of off-trend kind of numbers. Nowadays, also what's happening is that good quality commands high valuation. And when something like this happens, we do see a very, very sharp correction in the share price itself. So what's the best way to deal with a situation like this? One obviously shouldn't panic, but then what do you do? What steps can you take?
So Lisa, it's an interesting question. You broke it down in 2 parts. The first part you asked about the business not delivering on fundamentals, and the second part about the share price. So just linking back to the previous question, the share price element in a quarterly earnings outcome is actually not so relevant. It shouldn't be worrying anyone. It shouldn't be getting anybody excited either, right? What investors need to understand is they are investing in a business, right? As long as the business is good, regardless of what the share price does in the short term, they will make money. As long as the business is bad, again, regardless of what the share price does in the short term, they will lose money. Right. Now, when quarterly results come out, as a result, the only thing that an investor needs to focus on is whether the results are indicating strengthening of the business, of the quality of the business, or weakening of the quality of the business. Right. That's regardless of how the market reacts. Right. Now, there can be 2 types of disappointments. You talked about disappointing quarterly outcomes at times. There can be 2 types of disappointments. One is disappointments which actually aren't a reflection of any weakness with the business. So simple examples, COVID crisis happened, right? And many companies in the June 2020 quarterly results reported a massive decline in sales and profits, right? Now, it's quite obvious that this had to happen. If COVID has happened, nobody can buy products, nobody can sell products, so on and so forth. So this sort of a weakness in fundamentals is not something that should disappoint an investor, regardless of whether it disappoints the market or not, doesn't matter, right? It shouldn't disappoint an investor, right? Because it's expected. Instead, what the investor needs to do is figure out whether the reported results are indicating market share gain during tough times, whether the reported results are indicating some new initiatives being taken by the business in difficult times, right? Those are the elements that you need to focus on. Another example, more recently, input cost inflation has led to margin compression for many companies, right? Now, this again is an obvious outcome. If input cost goes up in an exponential manner, 1 or 2 quarters margins will be compressed. But is your portfolio company using this situation to its benefit and trying to suffocate competition more and more? If you see elements of that, and for that you need to assess whether inadequate price hikes are being taken at this stage because maybe raw material formulations will change in the next quarter, or maybe some procurement efficiencies will be done in the next quarter. As a result, price hikes will not be taken, competition will be suffocated, and this company will gain market share as a result. So I don't have to worry about the quarterly margin compression, right? So that's one type of disappointment, which actually is not something that one should be disappointed about. The second type of weakness in results is a genuine sort of deterioration in the quality of sales, of profitability, of operating efficiencies, etc. When it happens, right, the investor needs to figure out ways to either decide that, look, the company has become complacent or irrational, and hence this is happening, and this will not be a short-term pain. This will actually be a long-term impact on value creation. Or whether you say that, look, yes, the company has made a few mistakes, but from what I can understand, the management has realized that they've made these mistakes. They are taking corrective actions, and the way they are taking corrective actions, it's not going to be more than a couple of quarters of revenues or profits lost, and the company will be back at demanding dominance and profitability with high pricing power in future, right? So that is actually the hard work. Now, to do that hard work, obviously you have to go down to the places where the company is selling the product, whether it's a B2B or a B2C business, understand whether the management has realized from its mistakes and turning around the business again. You have to go and understand various other parts of the ecosystem and see how things have changed more recently after having seen a deterioration in the quality of fundamentals, so on and so forth, right? That's the hard work. Provided you do it, you will not make the mistake of exiting from a business only because one quarter's profits missed your expectations or revenues missed your expectations, right? And that's very important. Otherwise, you will never find any business which over 50 quarters delivered on expected results or expected growth rates in 50 out of 50 quarters, right? So this becomes, the question is very important, and it becomes very critical part of maintaining discipline in your research and hence portfolio construction.
Excellent. So I think you put it rightly. So in 50 quarters, there's no company that delivers, on point every quarter after quarter. And really the question to ask, like you said, is does the change in the earnings trend affect the quality of the business? And if the answer to that is yes, the quality is getting affected, and future also will be uncertain, then one can figure out the exit. If not, then one needs to kind of pick up. And of course, the answer is not easy. Like you said, it goes down to a lot of groundwork. Yeah. All right. So I also really like the way the book was written. Very, very simplistic, very easy to understand. And it had these little one-liners, which were quite nice. And I picked up one of those. And maybe, I just thought we'll sort of open it up a little bit. And the statement that stood out for me was that greed is a common human trait. And I think it's a very powerful statement to make. Greed is a common human trait as a fact. So do you think that in context to the stock market, that greed manifests more effectively than fear? And these are the two ends of the spectrum.
I think, Lisa, I remember we were discussing 20 minutes back why that the core traits that make a successful investor actually are not the technical ones. The technical ones are important. They are sort of the basic foundations, but the relevant psychological techniques that you need to have are really sort of mastered over, I would even say, decades of hard work. And the ability to suppress greed and fear, I think, is central in a way to those psychological techniques which drive your success. In that exchange that Rakshit and you were just having about what to do if a company has poor results, obviously you're fighting fear, right? You're fighting fear. And we can see that people are not very good at it. A couple of weeks back, Asian Paints had its second quarter results. For good strategic reasons, the management team let the operating margin slip. And there must be some people out there who got fearful because the stock corrected 5%. Now imagine if a company with 40-year track record of impeccable compounding can trigger fear. Imagine what happens when a lesser company has an operating margin drop, right? So fear is omnipresent in markets, and our job as investors is to capitalize on that. March, April 2020, a lot of very smart investors really lost their minds. They sold great franchises at throwaway prices. we acquired as much of them as we could because we knew there was nothing fundamentally wrong. And this is where our ability to work as a group which has worked together over a long time, a group which does a lot of bottom-up research based on fundamental techniques, we're able to buy things when others are selling. But let's go back to your question. Is greed more present than fear? Is greed more often seen? Yes, it is, for the reasons that we're just discussing.
Yeah.
You will have, say, out of every 100 days of trading, you will have 3 to 4 days where fear will be present, right? The other 95 days, by and large, stocks will be moving upwards, and everybody and their mother, father will say, we also want to buy stocks. And I have to admit, a fair bit of our business comes from that. People say, well, Marcellus has made so much money for 9,000 families. My family wants to be the 9,001 family to join the Marcellus consistent compounder portfolio. And if you think about it, greed manifests itself in other aspects of human life, right? Most Indian affluent families want to send their kids to America because they've seen other people send their kids to America, and they want their kids to study at prestigious places and live the good life. So the desire to move upward in the world because other people are moving upward and you believe the general flow of life is upwards is what I would say is the most powerful manifestation of greed in the stock market. Fear manifests, say, 3 out of 100 days. In those 3 days, fear really ruins people's portfolios and their compounding because they can't get a grip on their emotions. And therefore, if you step back and think about it, a successful investor actually is more of a shrink, a psychologist, than a chartered accountant, right? We have 15 chartered accountants in the team, and they are brilliant at their jobs, and we wouldn't be sitting in front of you without them. But those are chartered accountants. Our chartered accountants are those who have mastered the psychological aspects of investing. And that's really where, if you ask me, the men pull away from the boys, the women pull away from the girls in investing. The first stage of your career is learning the technical traits, right? The sorts of traits you described in the book: forensic accounting, valuation, understanding moats, understanding capital allocation. The final 5-6 years of your evolution as an investor is really the psychological side. For better or for worse, there isn't yet a great book on this. How do you master greed and fear when you're managing billions of dollars of other people's money?
Yeah, listen, I have to admit that I was extremely fearful in March 2020 because we've referred to that period a couple of times, and it took like all of any sort of willpower that one has not to panic and
Right.
not to because of course it takes willpower to not see those prices like we were talking about earlier. It's better that you don't see it on a daily basis, but you can't avoid it in such events. And when you see things, prices getting slashed by half, your confidence does get shaken, no? And I think what worked was that it ended fast. You didn't have to.
This is where practice helps. So we worked together through the Lehman crash. We predicted the Lehman crash 14-15 months in advance. We saw the Lehman crash. We moved to India actually after selling our business after the Lehman crash, and therefore having seen that one big crash helped us a lot. Believe it or not, when at the height of the COVID panic, which was sort of 23rd, 24th March 2020, when the country was put into lockdown, the memory which helped me a lot, right? The memory of understanding how greed and fear helped me a lot was I grew up in Delhi when the tragic riots which took place after Mrs. Gandhi's assassination occurred. And I remember in the 48 hours after her death, what happened, and I remember all sorts of wild rumors flew. Those rumors were actually almost all of them were wrong. Some people needlessly acted on those rumors and caused much mayhem. And that memory has always stayed with me, that if you can't hold your nerve, and I was, I think, 8 or 9 years old.
No.
I remember my parents, trying to hold it together, trying to just hold their nerves and the family together through the tragic week which followed Mrs. Gandhi's death. And I remember distinctly telling myself that if you can't hold it together when everybody else is losing their nerve, then this world will destroy you. And I think 23rd, 24th March, I remember some of our investors called up to say others are selling Bajaj Finance. Why isn't Marcellus selling Bajaj Finance? And our financials analyst stage pointed, why should we sell Bajaj Finance? There's nothing wrong with the franchise. On the liability side and on the asset side, Bajaj Finance is in great shape. Because of other fund managers' panic, Bajaj Finance corrected 60-70% in February, March, April 2020. We kept buying. We actually tripled our position, believe it or not, through those months. And none of this would be possible if we couldn't get a grip on our emotions.
Amazing. So investing is as much personal as anything else, really. I mean, you really have to put your mind, of course, but also your heart into it.
I think let me give an analogy. I think every Indian will understand. You can be the brightest.
Is it a cricket analogy?
No, it's the exam analogy. I think we all sat through millions of exams, no? From the time you're born, from the time you're weaned from your mother's breast, you start sitting exams in India, right? So one of the things I've seen is you can study as much as you want, be super bright, but if you can't hold it together in the exam in those 3 hours, then everything goes to waste, right? So we like reading a lot. We try to read a book a week and we love reading. But hey, if we can't hold it together when the chips are down psychologically, then all the reading, all the analysis is a waste of time.
Excellent. And we are sort of nearing the end of this. But before that, I want to really understand the use of cricket analogies in your book, which is quite abound. And I'm your atypical Indian because I understand cricket and I follow it per force, thanks to the rest of the family. But I mean, what is this? Why are we using these analogies everywhere we can?
Right. So, like you said, Lisa, you are an atypical person as far as cricket is concerned. Right? As you know, it's practically a religion in India. So apart from the fact that the team, we all in our research team in Marcellus who are all our kind of followers, fans of the sport. What helps is that this is probably the most widely understood metaphor that we can think of. Right, in India, maybe movies and cricket are the only two things which kind of brings people together. And cricket has such an abundant, or I would say such a wide-ranging presence of different cricketers. It's almost like a stock market, right? There are different stocks with different attitudes, right? From Ravi Shastri and Kapil Dev to Virat Kohli and MS Dhoni. Everybody is individually brilliant. They have their own attributes, which makes them successful, and we all have something to learn from them, right? So cricket sits easily when you try and use it as an analogy. People understand it because they intuitively know the sport and the sports' heroes very well. So for us, since you read the book, very obviously Rahul Dravid is our hero, and I think Rahul Dravid has those attributes which actually are as much important to cricket as they are for investing. So yes, I think it's just the simplicity with which we can explain concepts that's why cricket. No other reason. We aren't really trying to plug a Premier League or something like that.
Okay, I think Rakshit has a call. So thanks so much, Rakshit, for joining us. There's just one last question. So if you have to go, it's fine as well. No worries. But thank you. I mean, so many insights. It was really nice. Really nice.
Thank you. Thanks. Thank you, Lisa. Thank you. Thanks. Bye.
But before I let you guys go, I'm going to slip in one more thing, which is really in the recent news in stock markets, which is IPOs, their valuations, their value. Just a word on that. What are your thoughts? Have you looked into these companies in depth? And where do we go from here when it comes to value?
Lisa, one of the sort of things, basic probability concepts that I was taught in college was base rate, right? So before you enter any endeavor where there is probability of success, probability of failure, understand the base rate. What is the basic success probability of success of investing in the Indian market? And in chapter 2 of Diamonds in the Dust, we've shown that out of the BSE 500 as it stood a decade back, barely 15% of the stocks have given a rate of return above the cost of capital, right? So that means if you were to choose a stock at random from the Indian stock market, your chances of success are roughly 1 in 6. Right? So that's a stock in random. Now, if you do IPO analysis, whether the late 90s IPOs, the 2005 to 2011 IPO wave, barely 1 in 10, right? On the IPO front, barely 1 in 10 companies actually make money for you over any sensible period of time. So unless some miracle is transpiring out there that you and I are blissfully unaware of, it's highly likely that the same is going to apply. The same is going to apply to the current wave of IPOs. 90% of them will turn out to be duds eventually. 1 out of 10 will go on to be a long-term value creator for the audience watching this program. And how do you discern that 1 out of 10 from the 9 out of 10 which are going to be duds? The concepts are given in diamonds in the dust. Look for promoters whose books are clean.
Yeah.
Look for promoters who've got a track record of allocating capital sensibly. And finally, look for businesses which demonstrate moats. Salil said at the beginning of the show, Salil explained what are some of the characteristics of businesses with moats. And remember Salil's most intriguing comment. Salil said, brand is not a moat. Brand is not a competitive advantage. Yes. If you can't do that sort of work, a lot of people can't, right? Most people watching this are busy professionals. They're running their businesses, they're running their careers. Hire a fund manager, for God's sake. Don't do satta investing because others are doing it. FOMO investing, uski kameez, mere kameez se safed hai investing, because it's not going to work.
Yeah. No, absolutely, I agree. And I think in my personal opinion, individual retail investors anyway should not be getting into IPOs because information is limited, the experience is limited. I mean, in line with your idea of consistent quality, good quality stocks over decades, you don't need to buy it when it's IPO, when it's going for an IPO. You can always buy it 6 months later.
Look at the bright side of things, right? There was once upon a time where people couldn't gamble on anything else other than the stock market. Right. So you use the stock market for gambling. Now that's no longer required. You can download an app and gamble your brains out in our country.
Yeah, and one of the most neglected IPOs, Infosys. Look at that, and where that is. So I think there's so much that experience teaches, and clearly, you all have absorbed all of those little bits that experience has brought your way, and in such an articulate manner, you've put it in these books, and that's excellent because people can pick it. But just to quickly summarize, the process is important, which has been written down for you now. But more important is the psychological hold and control, and of course, knowing when to and how to use that control, which one has to keep inviting all of you guys back to kind of understand. So that
would love to come back. Thank you for hosting us.
Thanks a lot. Thanks a lot for this, and all the best. And thank you so much.
Thank you very much. Bye.
Thanks, Lisa. Bye-bye.